When it comes to presenting financial price data, there are numerous options available to help investors and traders visualize the markets and make trade decisions. I'd say that there are really three main types of charts that traders use, but the candlestick chart is definitely the most widely used. So the first and most basic chart is a simple line chart, and this will usually just plot the closing prices of a security over a set time frame. So it's going to show you the general price movement of the market. However, this type of chart doesn't contain the open, the high or the low price. So it doesn't show much information, and it doesn't show the trading range for each bar. This makes it not a particularly useful chart for traders, and it can even be dangerous because you're not going to be able to see the lowest or the highest price, and therefore you won't be able to see your maximum loss or profit that the market went to, which means it's more difficult to manage your risk. The bar chart adds to the line chart by incorporating more information into each data point, so you can get a better idea of what is happening in the market. A bar chart is made up of a series of vertical lines representing the high and the low of the trading period, with horizontal dashes to show the open and close, where the open will be shown on the left of the bar and the close will be shown on the right. If the close price finishes higher than the open price, the bar will usually be coloured green or black, which shows the market has finished higher than it started. And if the close price finishes below the open price, the bar will be coloured red. So, like the bar chart, a typical candlestick chart will show the four main price components: the open, high, low and close for the trading period, which can span as short as a minute to as long as a month or even longer than that. But unlike the bar chart, the way the candlestick is drawn gives traders a lot more information. As well, various styles involving shading or the direction of the open and close bars serve as visual tools for a trader to easily grasp the price behavior in one quick glance. For example, a candlestick that is white or green means that the price closed higher than it opened for the period. A black or red candlestick signifies that price closed lower than it opened for the period. The vertical lines above and below the candlestick's main body notate the highs and lows for the period. So if we break it down, each candlestick is made up of a body and a wick, which may or may not be present depending on where the market traded at. The body represents the opening and closing price, and the wick shows the high and the low. A wick that appears on top of the body is also called an upper shadow, and a wick that appears on the bottom of the body is also called a lower shadow. So the way the candlestick is drawn allows us to understand a bit more about the way price moved during the trading period. As you've probably guessed, there are also candlesticks where the open is completely equal to the high or the close is equal to the low, creating candles with no shadows or bodies. If a candle has a long shadow, it simply means that the market at one point moved a long way from the open or the close. These are also important to take note of, as they can indicate whether trends are set to reverse or continue, and we will look more closely into these different patterns later on. In candlestick analysis, it's always helpful to look at nearby candlestick patterns in relation to a potential signal candle. These are often known as confirmation candles, giving the trader more clues as to whether a pattern will be completed or not. So that's the very basics of the candlestick chart. There are other chart types as well, such as point and figure charts, range charts and Renko charts. But as I said, the candlestick chart is by far the most widely used by traders. In the next lecture, we're going to look at the building blocks of the candlestick chart.